Welcome to the Deployed Podcast, where strategy, ideas, and capital come to life.
Hey, everyone. Thanks for joining me for another episode of Deployed. I'm really excited because this is our first time actually doing this while we're live. For those of you who don't know me, my name is Michael Kearse. I'm a real estate investor and fund operator. Over the years, I've worked with a wide range of investors who have built successful in very different ways, business owners, professionals, and operators, many of whom eventually start asking the same question. Is there a smarter way to deploy capital, especially retirement capital, outside the stock market? On Deployed, I'm not here to pitch. I'm here to understand how successful people think about capital, risk, long-term decisions, and to explore how tools like self-directed IRAs fit into that thinking. Today, I'm joined by Stefan Steinberger. He's the active manager at Burton Capital, a real estate fund. How you doing, sir? Thanks for joining us today.
I very much appreciate it. I'm doing very well.
Awesome. So before we talk investing, I like to get some context. What did your path to success look like?
Well, I will say when I was younger, as a kid, I had my own set of struggles, but I'm sure a lot of people do. Mine is, I've really worked in a series of fields now. I started when I was just I think I was 12 years old about when I watched my first business documentary. And before that, I'd been studying history and politics too. By the time I was 13, I was running, some type of investments, public. And by the time I was 14, I was, several people had taken a lot of interest in me. Started with one or two when I was even younger. It made a huge difference. By the time when I was 14, and throughout my teens, I ran active portfolios. I sort of consulted for, governments, among other things in the developing world. By the time I was 15, by the time I was 15 or 16, I was doing other stuff. And there was a lot of interesting things back then that I had to overcome. The time I had made films at that point. I was a professional actor, among other things. I had been working in those fields. By the time I was about 19, I had been, it was an estimate, or I thought it was an estimation, but it turns out it was confirmed. I was offered apprenticeships out of thousands of people. One in leadership, one in, I was very selective. Out of all those people I'd basically ever worked with in certain variations, among other things. And then I was offered a big entertainment one, and I wound up, being a stagehand on one end, and I taught at a top 10 martial arts and leadership school when I was just 19. Then, I'm going to leave some stuff out in this because I have so much that has been going on that, it would take me hours to explain, so I'll leave a lot of stuff out. But basically, by the time I was not 15, I had my own business plan in real estate. By the time I was 19, I was continuing to invest and running different, things for people. I was teaching and I was whatever. I basically figured out how to ROI play real estate sector. So, I had worked on a lot of altruistic projects in the nonprofit space and trying to make a meaningful impact in various ways. I had mentees, among other ways, to try to do some good in the world. At that time, I basically realized how to play the ROI game on a college degree. So, instead of applying to the, Ivies and the whatever, or the NYUs, the MITs of the world, I applied to, I was at SUNY Empire, then I applied to Baruch College on an ROI play. And of course, there were other things. I did all of these things besides career and money and whatever else. But a part of the component, which is what you're asking about, is the career stuff. So I'll focus on that. So I was there and I did that. And I used the opportunity to take money I made from investing and start paid for it because it was the best ROI in the world as far as colleges went. And then from there, from Baruch, I made the decision to buy, buy buildings. So I started buying apartment buildings, with the money, and that would have sent me to those schools, like a much more prestigious school, like college fund money. So I bought my first 4-unit, then I bought another 4-unit, then I bought, now I can basically retire if I really want, but I bought another, building. I have no interest in retiring at all. I mean, I very much enjoy what I do and I have passion and altruism and a lot of other things. But one of the things I did, and as I said, I'm not going to talk about everything, is I did that. And then I raised my first fund. So I bought money with other people's money, which is a big deal because I'm sure, as you know, that's something people generally do in their 40s. So I was 22. I was running a fund, my first fund operationally. Then from there, I was all into, I'm still working in leadership and management and media and finance and other stuff. And I'd put some other deals and projects together. And I was really interested in leadership as a concept. So then I decided, well, it was time to get, a super school on my resume. I had to get, the NYU, the Columbia, the Harvard, the something. So I was recommended by someone that I go to NYU. So I applied to NYU and I spent time there just so I could get the prestige among other benefits of NYU. And then I transferred back to Baruch, where I'm making more acquisitions. And then I convinced a bunch of people to put some deals together somewhere along the line. And I did a bunch of other stuff for work too. And I saved a bunch of people. I risked my life to save a bunch of people. And then I saved a dog the same way. I released stuff in the economic space. My background is econ, largely in business. I won my first award in econ when I was like 21 about. I won I won media awards. I've done all sorts of other stuff at this point. I think it's like 216 pages of accomplishments in my portfolio on LinkedIn. I don't remember the exact number, but that's an estimate. But that's kind of what my journey
That's
is.
kind of what my journey is.
That's a amazing, impressive background. There's so much I want to dig into. But for a moment, did your relationship with money or risk really change over that course of time?
I think honestly, my relationship with risk, I think it's one of those things where I think in general, my actions might have stayed pretty consistent of what I did overall. But in general, I think the more experience you have and the more background you have and the more accomplishments you have, you don't want to get overly confident ever. It's very dangerous when you do. I mean, really bad things start to happen. But, you get more confidence. So, running a portfolio at like 14, when you're starting out, you feel uncomfortable, whatever. You get older, you feel a bit more comfortable with making decisions, right? I would say. As far as my relationship with money over that time frame, I mean, I always have to remind myself constantly, and I think everybody does to some degree. I don't think I'm unusual on this, but I think, money is something basically everyone likes, right? It'd be very hard to find somebody who doesn't care at all about money. It's understandable why. Um, and it's an important resource. It's an important thing that can do a lot of good in the world. It can do a lot of bad in the world. It can accomplish a lot of things if you really think about it, right? I would say my relationship with money might not have inherently changed, but I was always exploring money and fathoming it, kind of studying my entire way. And I think more important than money is assets, because no one really has that much in cash anyway. And money is inflationary; it gets killed by inflation over time, right? But I would say, if you think about something like, I have to always remind myself, every time I make that next trade, why am I doing this? Who am I doing this for? Just like everybody does. Like, as I said,
Like,
nothing special.
as I said, nothing special.
If they're doing it
If they
right,
if they're doing it right,
and I have to always remind myself, and I have to always focus that because every person in the world is corruptible on some level. And it's very important that I consciously, which I do, I think, a very good job of, making sure that regardless of discussion at the time, of any time in one's life, that you just don't lose not just what's important, not just good intentions, but I'd say you don't let it slowly, like, destroy you, among other things. And
among
I
other
feel
things. And I feel
that I am not, I don't think I need to mention here, but I think it's a constant understanding of its use, understanding of what it is, understanding of all that other stuff, while simultaneously always understanding, the passion, the meaningful impact, while also simultaneously understanding, to be careful of it not being too dominant in your life. And I feel I've done a good job of it and keeping a healthy relationship with it.
I like that. And as
healthy relationship with
as you became more successful, did the way that you thought about capital evolve?
I think it does for everybody a little bit as you learn more, right? Because money is just a tool and money is also just cash. I appreciate it. I was going to say the way I thought about it. I guess in some ways it made me think about things differently. Like I have investments all over the place, although I have not like, like forsaken America. I like really believe in Western democracy. And I think that's really important. But I would say, I think the idea of it being a tool in my mind comes from kind of a Steve Jobsy mindset, minus all of his terrible qualities. I think an interest in, I think the way you think about it is kind of somewhat relative to the person. But I also think that there are some key principles that are relevant to it. I think money I think when you're really good at something, and I was this incredible, like, I guess not to, you know, statistically rare, accomplished person, right? He was really good at what I did. And I think when you're good at it, it definitely helps you enjoy it more. Although even if you took it out, I'd still enjoy it. I might enjoy it a little less. I don't really know. But, being good at things makes a difference. I think my thinking over time on money as I got older, you realize that it really by itself, it's all the things that back money that really give money its value, right? Government, assets, other things. Money itself is not that helpful. No one should be keeping above a certain amount of it in a portfolio unless it's a defensive technique strategy, right? Like portfolio preservation. And and you realize that money largely is a equivalent of time. Money is an equivalent to
Money
do
is
things.
an equivalent to do things.
It's also something
It's
that
also something that
just keeping in your bank account endless amounts of it is not smart long term, I would say. I would say
is not
I
smart
probably
long
came
term.
to
Well,
thousands of
that
other
real quick,
things.
I want to stop you there, Stefan. That led me to my next question. At this point, what role does liquidity play for you now, and how important is predictability?
I suppose. Okay, liquidity. I believe in having some liquidity in your portfolio, whether it's public. I mean, there are lots of ways to do it. There's bonds, there's stocks, there's public equities, there's public stuff. I think I keep most of my money is tied up in investments somewhere in the world. Some of it's less liquid, like a piece of land. It's not illiquid. It just takes it might take. I'm just gonna throw a random number out there, 60 days to get rid of it, right? Or to get it off and to deal to somebody else.
Deal
Yep.
to somebody else.
And I would say liquidity, it's important to make sure you have money saved up. You're not over levered. You're not in too much, you're not in unsustainable levels of loans. No one should be over levering. It's okay to use some debt, I think, but you have to balance it. I've worked all these years in this. I think liquidity, I keep some of it, and I think some cash is healthy. I just think what starts to happen with a lot of people is they do too much of it. I think a better way to look at it is like balancing things. Like, for example, to make this up here, let's say somebody has like 50% of a property, a real estate rental property in equity. And the other, and the market in '08 tanked 24%. In the Great Depression, it tanked 35. At the end of the day, if you own real estate and you rent out the property, you're still cash flowing and making money
You're
regardless
making
of the
money
level.
regardless of the level.
And you're able to and you have enough equity in the building that, there is that tank, you're fine. Right. And, you're always, that you're not going to be below water. It's incredibly unlikely, right? Ever. And the same is true for others. So I would say, I generally am a mid or long term investor. Usually, it's rare to see me pick something up that's short term. Like it's just not what I do.
It's just not what I do.
Usually, because I think it's rarely works out. But I will say,
But I will
uh,
say, uh,
in the midterm, long
in
term,
the
I do
midterm, long
believe
term, I do believe
in some liquidity, maybe some gold for recessions, maybe some cash, other things like that.
Now, and really quickly, so how do you decide when something is worth your attention versus if it's like just noise?
That I would say I would say about 30 characteristics I look like. I look at probably 30 things on a checklist, variables for position, that might interest me. And again, like those might vary a bit depending on whether you're interested in gold or stocks or bonds or something else. As for whether it's worth my time, I mean, depends on what you mean by, worth your time. Because I could buy a growth stock, I could buy a value stock, I could buy a blend stock. But whether or not something is worth your time largely depends. I could buy a lot of other things, but and I do believe in some diversification, but whether somebody is worth your time has to do with a few factors also, like how many positions am I keeping in a portfolio? Am I open? Like, for example, I might have all my money I'm willing to invest tied up in different investments around the globe. So I may not have a lot of liquidity right now and be looking for an active pick. If I'm looking at a startup or something else, like outside of helping a friend out and advice maybe, and that's where I might consider it, whether it's a good or bad idea. I might have to look at 2,000 positions, really, like within the Wilshire 5,000 or within international, or within something. I might look at, I don't know, 2,000, you might have to look at 2,000 startups, just to pick a single startup in a way that you feel is,
Yeah.
ethical,
in a way that you
passionate,
feel
whatever.
is, ethical, passionate,
And smart.
very similar.
ethical,
Like,
passionate,
that's
and
some
smart.
stuff.
Very
But like,
That's
that's some
some
of it.
Yeah, very
That's
similar to Robert Kiyosaki. Like he mentioned in his book, right? He would look at over 100 properties before he would pick one deal. As that's just because what I've started to learn, and once I started to get into this, paying attention to assets and investing, is it just happens organically because you start to learn what to look for. And this is a lot of crap out there. Are there are there any investments that don't even interest you anymore that you don't even look at, or do you still consider all types of positions and assets and investments
I mean,
opportunities?
Robert Kiyosaki has some good ideas, I think. It's complex and it's a basic investing book. But yeah, I would say yes, he has some good ideas. I don't, I agree with. I would say what you said, asked before about hype. I would say hype. I mean, hype doesn't inherently make for a bad investment. It's what the things that go along with hype, right? That make things go up. So you start to see overvaluation.
valuation. You
You
start to
start
see
you start to see, I'm trying to think about the best way to say this. You start to see, I don't know, balance
you
sheet
start to
problem,
see uh
cash,
I don't know, balance sheet problem.
cash.
Like the
You
movie
start,
about GameStop. Did you ever see that?
yeah. I've heard of it. I think I may have seen it. Those finance films can be a lot of fun. I don't think I'm their target audience usually, but I do enjoy them often. I think in general, from all of this, Michael, I would say, which I again, very thanks for having me again. But I would say, there are investments. If I see something, I do look at hype a little bit sometimes as one factor, but by itself, it doesn't really make you much of a good investor from most of what I've seen. I would say there are investments that if I hear certain criteria, I will immediately be like, know what, this doesn't interest me enough negative criteria. I think I only have so much time in the day. So, if something doesn't really interest me or see value among other things, I will ditch it. And I will tell people that,
What
and
are,
I will tell people that, I don't always pick the hype. So I would say in general, I'd say I've had a good run with all of this, but I would also say, there are other things that just don't interest me about a pick.
what are
Yeah.
some of those things?
So, yeah.
Do you know, are there anything, or is there anything in particular besides the hype, right? Like, hype, there's going to be hype, and like you said, things come with it. What are the little key little things that make you go, nah, I'm gonna probably sit on the sidelines on this one?
Insane P ratios. It's obscene what some of these things trade for. If I see a position and it's like 2,000 times earnings, it's going to the moon. I'm like, probably not. Sometimes too much interest from other people. I like to look
Yeah.
for things that other people haven't seen if I can find them. Power. I would say too many scandals is a red flag. Too much overvalued by the Buffett indicator or other things.
The Buffett
Not
indicator, I
not
love it.
reviewed smart in an economical way. There's a lot of people in this life I could have probably screwed over, and I'm glad I didn't. But I would say that, there are a lot of just shitty behavior that comes out of those things that are humongous red flags. I would say, what's another one? I would say poor balance sheet. If I see a company and it's like, you owe obscene amounts of money, and you look at the numbers and it's like obvious they're never going to pay this off. Zombie companies, I think those are red flags. Let's see. I think I like to see hype and ambition and whatever. I also like to see good management. So if I see like a crappy manager who clearly doesn't know what they're doing, even if it's a really good company, that's not a good thing. I think, a company that has, many other problems I could think of, but those are like some of the ones I think of that like. Also, I would
Also,
say,
you know, I would say
does someone work there? Because if it's a close friend of mine, I'm very unlikely to like work there because I love my friends, and you never know what's going to happen there. So, like, it's one thing to give a friend resources to help them. It's another thing to be like to working with them, and it's often a bad idea. I think there are a lot of other things that come to mind, but I won't mention them here.
Have
There are
you
a
had
lot of other things that
have
come
you
to
had
mind, but I won't
experience
mention them
where
here.
you've worked with friends or you invested in friends and it went south?
Oh, let's see. The structures I use for work are designed to like mitigate that to make sure that doesn't happen. I have not had many friendships that went south, or really any friendships I've never had friendships that went south because, that happened because I was working with a friend, but I've had it like come close. So like, I'll give an example. I've had friends where they're like, you know what? We've known each other a long time. They've never asked me for anything, right? They don't ask me for my time. They don't ask me for money. We're friends, right? It's clear we care about each other. So they say,
Yep.
I want to go invest money and be someone who, does whatever. So I might advise them on some type of portfolio. I'm to help them briefly. If it's like, especially if it's broad index and over time, I know they'll be fine. I might agree to like, okay, you're looking for friends looking for a job. Let me help you get a job, potentially. I might be like able to give them some resources or help in various ways, but I'm also like very like veto anything that is like, can I have a loan of $50,000? I'm going to be like, no. And if you're going to ask me for a loan, it's going to be a few $100s and it's going to be, or I'm just going to give you this couple $100 or something. I'd rather that, right? Than stress the relationship. So I would say I haven't had many issues with it, but I would say I've come very close multiple times. And as I said, I would rather literally write one of my close friends an apology letter or a check who I really value than like be directly involved working with them. Because in a work setting, especially if you're bringing on somebody, your A might not be getting the best candidate because you're employing your friend, and B, doing business with them is just it's not worth it. I love any girl that I marry. I love love of
any
my
girl
life.
that I marry.
And any friend I marry or friend I become close with, not marry, is someone I really want to be able to rely on and vice versa. And burning bridges, if it is, I don't think is worth it. And if you're going to do that, do it in a structure that is very like not likely to hurt anyone. Is
No,
usually what I'd
well
recommend.
said. Well said. Now I want to move on for a second to self-directed IRAs. How did you first learn about that? How did you first learn about self-directed IRA?
Okay. So you have Roth IRAs, whatever else. I was probably looking at some finance journal when I was like 14 years old, and I was studying it. And it was something that I would say in all of my like research and what I've done for work, I would say it's just something that comes up over time. Part of money is retirement. With retirement comes how do you retire and all the studies on it. The thing you have to remember about a lot of investing and a lot of Roth IRAs is it's kind of customized to what the person's goals and priorities are, right? I first learned about it when I was younger, on some level. I would say that studying what I studied, being in that world, I feel like there are definitely cases where people should be having them for your retirement fund on an individualized basis. There are also instances where those things have limits. And I would say like a lot of investing products, I would say for all of my work and everything I've done, I mean, those are all worth it, conclusions. I think they're really important. Important.
Was th-
Um,
was there anything that kind of
yeah.
surprised you about it once you kind of understood how it worked?
Well, it's surprising because it's very limited. Sometimes with the government, like supported products, like a 401k or a Roth IRA, things like that. They create incentives, right? They create incentives for saving every month. They create incentives for investing every month. I think it can be very limited, in what it offers. I think it can be very, very limited or limitless. I think it could be helping people. I think people I love. I think everybody wants to be able to retire and be able to, or for the most part, at least have the option to retire, even if you don't pull it. And everybody, I think most surprising is when you create a product like that, the government creates incentives, right? Whether it's like tax savings or something else. I think one of the things that surprised me is that so with so many Americans living paycheck to paycheck, for better or for worse. You know, there are so many people who really should be using one, in a Roth IRA, a 401k savings plan, or investing through there or something that aren't and are really living paycheck to paycheck. So I don't know. I think
So
they, I don't know. I think it surprises me how few people use them that really should be for their circumstances. Yeah.
I understand. So let's set aside the okay, right? Let's set aside that traditional retirement account, whether it be a traditional Roth. I want to really focus on that self-directed IRA because as you well know, right, the self-directed IRA gives the lender more control, right? The 401k, you can only put your money in there. Oftentimes, they may give you a company match, and the company is deciding, depending on your risk profile, if they even do an interview, what stocks on the stock market they're going to invest for you, right? Whereas with the self-directed IRA, if you qualify or if you happen to already have one, you can invest in someone like yourself. Someone can lend money to you or to one of your businesses or to one of your funds, right? You can I've spoken to custodians that allow their clients to invest in Forex or to invest in crypto. Have you had any experience with the self-directed IRA in that regard?
Well, I understand it pretty well, or like to think well. Let's see. The first one you mentioned, yeah, that's a traditional index. And for, 90 something percent of people will not beat the market and are better off, having the money tied up in indexes or something, maybe not exactly indexes, but something similar in my mind, because most people should not be trying to beat the market because they're not going to. That's just what the data says. Better to like have that and think about your retirement, which is something a lot of people forget to do. I would say, as far as the other one goes, how to think about that. I would say, look, lending products, I mean, well, look, the government can, everybody can wind up a lot of people can wind up screwed up. The government can wind up screwed up and biased when they create these things. So can companies. So can everybody, right? I mean, no organization is doomed to be evil or good or be work for people or not, right? Or things can get better. But I would say on the lending, be careful of those lending incentives. I'm not saying, again, as I said, there's situations where that probably is a good idea for people, but I think it can become really dangerous and really bad. I mean, honestly, when we think about those things, I'd say the crypto angle. I mean, here's the thing about crypto. Incredibly speculative. There are a ton of problems with crypto. I don't think crypto's doomed or anything. Inherently. I mean, I've seen people make a lot of money from it. It's just, and there is growth and stuff. I'd be very careful because, like the .com bubble, blockchain is a very underdeveloped technology, I would say. Not to say it's useless, but it's an underdeveloped technology, and it also has a lot of problems with it. Now, it has a lot of other issues with it. Do I think crypto is like doomed? Necessarily, no. I would also say, one of my characteristics I didn't mention before, but I'm not gonna, is you have to really understand what I believe in the Buffett concept to some degree, at least. You have to, at least to some degree, understand what you're buying. And I think for most people, they're uneducated on crypto. So they don't know what they're talking about. So, I think, is it a good thing that they have access to that? Maybe under the right structure, under the right fees, under the right everything else. But, is crypto, is that a good thing that they have access? I mean, I don't think it's necessarily a good thing that they have access through the IRA format because, the truth is they can do that through their own accounts anyway. If it's about like tax benefits for crypto or other stuff, I could see people incentivizing the technology for its applications. But if I was like thinking about this, under very specific circumstances, the second type of IRA could probably make sense for someone. But I think, a lot of the time people get, again, caught up in this hype of crypto is the future or whatever. And the result is people lose a lot of money. A lot of people get hurt. Like in the AMC GameStop rally, so many people lost money. So many people lost their shirts. A lot of people who worked at hedge funds, the big hedge funds, also got hit hard and got hurt. But, very few people actually made money. And out of the people who made money, the big chunk of the people were all like hedge fund people. And I really have sympathy and I worry about people to some degree. Everyone has limits to their sympathy but on some days, or there's like same way, like overall, I love what I do. And once in a while, there are times that I don't like it as much, right? But on the whole, I love it. So I would say like with an AMC or a GameStop, I would just be very, very cautious. I'm not against somebody doing that inherently, but I really, investing is a very dangerous game because you're really playing with people's money. And a lot of the people who are owning GameStop, I mean, there are a lot of other, just like crypto. I'm not going to go into all the problems with it, but one of the problems with AMC and GameStop, and it's not the only problem, is that, a lot of people who are buying those things were people who were deeply in debt and they thought that it would like save their finances when they really should have been taking different measures, right? Like paying off that debt and other stuff. And as I said, not inherently a bad thing like crypto, but I'd be very careful because, it really hurts. I mean, it hurts a lot more. And turning investing into a gambling casino is probably not your best choice.
I agree. I agree. So staying along those lines with the self-directed IRA, you mentioned that, maybe it's a good thing that they give you that platform, that technology to have that freedom. Do you think that the self-directed IRA giving someone that power to be agnostic in investing outside of the stock market, what is your thoughts around that specifically? The self-directed IRA gives someone the autonomy to invest in things outside of the stock market. What do you think about that flexibility in regard to that product? Do you think that's a good thing?
I
Do you
don't
think
see
that's a
anything
bad thing?
objectively wrong with it. I just think it has without certain things, it will have a tendency to get abused. I'd be careful to make a statement like it's objectively bad. I also would be careful to make the statement to say it's objectively good. I'd say on the application. I'm sure it's going to be great for some people, not just firms and stuff. And it's good they have selection. I just think there needs to be big, not just and stuff. And it's good they have selection.
Do you have a self-directed IRA that you leverage?
Because of my structuring, I don't believe I do. I'm pretty sure I don't. I track my finances as well. And also everything I'm in is, owned by an LLC or something. So
What do you think retirement capital often aligns with better? Do you think it aligns better with passive investments or active ones?
I would say, I don't think, finish my last question. I don't think I Roth IRA, but I would say a lot of my money is tied up in entities such as or similar to, LLCs or trusts. I don't usually use the Roth IRA model to answer your prior question. Right now, I don't think I do much of one. I would say with you on your end of things, and do I think it aligns passively or actively? I mean, depends what type of retirement and goals you have and whatever else and situations, but I would say probably passive. I think most people are better off owning, passive investments over active investments. I mean, that's just the reality because for the most part.
Great answer. Another follow-up question to that. What appeals to you most about lending versus ownership or operations?
Again, it's situational to what's a good or bad. I'd say with lending, I mean, it depends on the currency you're lending in. I think a lot of it's incredibly speculative and risky. Depends on the world you're operating in. I would say lending. I'd say ownership is better for most people as a general rule. I don't think exposure to lending is bad, but ownership is better. I think lending is a very, I think lending is not healthy. I think lending can be good. I think lending, the yield on bonds can be good and income and stuff. The pros and cons to both. I mean, equities tend to be more volatile, especially compared to high quality bonds and lending. I think depends on the lending and the risk profile and the ROI, among other things. I think on average throughout history, you'll probably have done better owning, stocks to bonds. I don't think that US treasuries are like junk bonds, but they're definitely not as risk free as they used to be, because of just the handling. The handling of things. I think in general with lending, in a low interest rate environment, it's very hard to make money. I think in a high interest rate environment, it's far easier to make money.
Like real estate.
Yeah. I think that's true. I think real estate, honestly, as long as you're not paying like 18% on a mortgage or something, generally, you can always refinance real estate very easily and it's pretty steady cash flows. And you
What
don't
about for the
overlever
lender?
yourself. You don't overlever yourself.
What about for the lender lending on real estate?
I think banks can make a lot of money. I think they can also lose a lot of money. Again, depends on the bank, how they're managed, a lot of variables that go into that. I can't even get into all of them here because it'd take forever. But I think in general, being a lender is, I think there's such a thing as normal lending and bonds and other stuff, which have their benefits. There's also, such a thing as, owning instead of bonds, I think for the lender, there's vultures, who try to lock in their money, but their model doesn't work if you have low interest rates because who wants to vulture for 3% interest, right? It's not worth taking the risk of a high risk company. Really, usually, I think bonds are generally I think for the lender, it's like investing, right? It depends on what you're doing. There are some really smart bankers. There are also some bankers who get themselves into the stupidest stuff. It's variable.
How about for the everyday passive lender lending to someone like you in your debt fund or lending to someone like me on a real estate deal, right? What are your thoughts on that?
Speak to your finances because I don't know your finances. I might have some clue, but I don't have access to like full your tax records or a lot of other things. But you sound like somebody who's has their impressive qualities. So I would, in that lens for myself or you, that kind of person like myself and maybe you is very much. We're low risk targets, I'm a target that has a lot of capital and is, has a decently good track record now. So I'm probably on the lower end of, lending risk, I'm probably on the lower end of things. So, you'll probably get a lot more safety from someone like me. You also get a lot more because, I have certain buildings insured and stuff. on multiple levels and by other people, and I have a lot of equity in them, you probably also have less income, less return. And if you're similar to what I'm describing, I'd say the same for you, probably.
No, that makes sense. Thanks for sharing that. How do you think about time horizons when capital is already set aside for like the long term?
As I said, for most people should be index fund investors. Most people should be index fund investors around the globe. For some people,
And then
I think home equity isn't a bad thing. Yeah. Home equity isn't a bad thing. Yeah. So what are you going to say?
yeah, I'm sorry to cut you off. I was just going to ask, what advice would you give someone sitting on a large retirement account who may be feeling stuck with some of the traditional options, right? But they feel stuck with the traditional options. What advice would you give to that type of person?
I would say if they're young, I'd tell them it's okay to take a little more risk, probably, or borrow more money or whatever else. If they're older, I'd probably say stick with low risk options, more conservative, depending on the situation. I'd probably say if they're middle aged, there's low and there's high risk. I'd say mid risk is kind of non existent.
And I agree. What type of conversations do you think they should be having around retirement capital, if any?
Well, some of the examples, like for a lot of this, because it's way more complicated, but I would say be honest about money. I think people try to like hide their finances among other stuff. 20, I would recommend, 20%, be honest about what percentage of your money are you saving every month. Be honest about, your projections. Most people don't plan 40 years ahead. They really should be. The same way everybody should have a will for the most part. I would say, being, I would say being able to, I would say they should be clear about realistic, but also amazing, well thought out, exciting investment goals. I think they should be having conversations about their allocation. I think they should be having conversations about how would they feel if the market tanks 25% tomorrow and they lose a lot of money. I think they should be honest about how do they feel about risk in practice? How do they feel about upside? How do they feel? What are the objectives of what retirement looks like? How much money do they want to make sure the kids get when they die? I think those are all key questions. I think how well do you sleep at night with risk or morals or anything else or big ones, right? Because you could have some fund that's making a ton of money and you don't align with their values or something else. Or maybe that's a bad example because there's a lot of problems with ESG, DEI, but maybe there's all sorts of stuff, I think you need to be honest about your saving money because most people are not fiscally responsible. They're just not in practice to what they should be doing, at least largely. So, I think you have to be having honest conversations about health risk. In retirement, I think you need to be having honest conversations about a lot of other things or things to be thinking about. What does that look like? Kind of like how you go into a relationship with romance, you might also go into a relationship with that. Think about the people who are really important to you. I think people should be. Think about the people who are really important to you. I think so. Like, you have kids, you have a brother, you have a whatever, you have a sibling who doesn't have retirement funds, you have, spouse, you have a sibling, maybe you have a close friends. You want to make sure them and their kids are taken care of, right? Maybe you have a charitable project. Maybe you have something else that's important to you. So, those things, all need to be accounted for and more, really. Yeah.
Well said, Stefan. Well said. Well, listen, that's all the time we have for today. If this conversation resonated, share it with someone who's built success and is now thinking more intentionally about how their capital is deployed. And if you're curious about how self-directed IRAs can be used for passive real estate-backed lending, you'll find resources in the description. Thanks for listening to Deployed. Thanks for being part of us, Mr. Steinberger.
Thank you.
You've been watching the Deployed podcast, where we deploy insight, capital, and growth.